Hey everyone, welcome to CoveredCall ETF Investing, your central hub for deep CoveredCall ETF data. Today's video, we're cracking open, once again, the CoveredCall ETF ALLSTAR tracker, a Google Sheet I created to look at bond CoveredCall ETFs, their performances, their AUMs, their average volume. And since bonds are obviously a critical part for many investors, and especially for those who are income investors looking to gain a little bit of additional income, let's go through the landscape of bond CoveredCall ETFs. Now, if you like the info that's presented on the CoveredCall ETF ALLSTAR tracker, you can head over to the description below or the very first comment that you see, and there will be a link over to my Patreon if you want to look at this Google Sheet for yourself. It's updated monthly, and come July, the info that you see, which is currently static, is going to turn live. So performance data will be live, current yields, it will all be live. So with that being said, let's get into the video. All right, next we're looking at bond funds, especially on the Canadian covered call side. Bonds have been beaten up hard this year. So we want to kind of try to look for what kind of opportunities can we get with bond funds and what their yields are, less yields, more yields, which ones are stable, which ones are healthy. Let's actually go through that. So we'll go over to the fund category here, and we're just gonna clear everything, and we'll just click on bonds. Let's see what we get for bonds. Okay, so this is everything on the Canadian market in regards to bonds. We got Evolve ETFs with literally bond. It's got an unhedged version, which means that it's getting exposure to, so it's with being unhedged, means that currency has more of, it will be a factor in the price performance as well. Then we also got the US dollar version, Bond U, and then we got a whole heap by Global X, LPay, MPay, Pays, and SPay. Pays and SPay almost look pretty similar, so I'm not sure what the difference is between those two. Also, Pays is brand new, just launched at the tail end of May. Some of these other funds like LPay, MPay, SPay, been around for a couple months. Overall, these bond funds are relatively new, haven't been around for that long. The probably oldest fund is either going to be this one by Hamilton, HBND, or HPYT. But you can see the differences in yields. So anyway, let's run through performance and just see what we get. Now, naturally, if you're an income investor, you're gonna be, I would say, more or less, you're gonna be attracted to the things like HPYT of the world. But we'll go through the differences in each of these and kind of measure them up. So as we head through to, like, say, just 3-month daily volume, we see Liquidity, HPYT, hands down. You can tell it's the most popular. I wonder why. Right here is the reason why. By far the most popular. And then in second place, AH Bond. I'm not surprised. Again, these funds kind of launched around the same time. You still get a really good 10.5% yield with H Bond. And then everything else is kind of more on the peripheral as far as, just trading volume is concerned. Is 8,000 units being traded on average daily something to be worried about? No, in my opinion, not really. I think it's more a case of, like, once you get in and around 1,000, under 1,000, the potential for an illiquid fund to buy could end up jacking up the price. That's just how it works when you are buying and selling, or you could be waiting a long time if you try to sell it. And then when we move over into performance, we can see over the last week, the last month of May, taking a pretty good hit there. Over the last, call it 6 months, they're all down. But SPay is the only one short term. It's the only one that's actually kind of up a little bit. So, well, I should say, over the course of 1 month, they're all up. They're all seeming to gain a little bit. But over the last 6 months, there are still opportunities, no doubt, here to get into a bond ETF and get that fixed income portion for your portfolio. But as we can see here over the last month, as equities have, I would say maybe struggled for sure in the last trading week of May, that bonds have started to pick up just a little bit. So could there be a bit of a rotation going on from equities into bonds? I mean, that's always kind of the talk of the town right now is, when are we going to start to see more of that shift? As the talk of interest rates falling, we should see bonds start to pick up a little bit more. So get a good yield, and so we can get a really awesome yield and a little bit of performance as well, price performance out of it, right? Because just a reminder, this is the tabs we see here, just price performance alone. If you see price performance and dividend, that includes the distribution that gets paid out. But none of these funds have been around for that long. None of them have been around for even a year yet. Okay, so regardless of all that, we can filter by 6 months. Which fund is suffering the most? HPYT, highest yield. Maybe we shouldn't be surprised with that. Mainly because, right, the higher the yield something is, the more it's just going to drag down on price. But the more moderate something is, then the potential for it to do better over the long term with price-wise. And that could be a psychological win for you, picking up something that still pays decently and getting a little bit of price performance out of it, staying stable, and ideally growing for the long term. That's kind of my mantra. I like to seek yield but lean growth. Okay, so as we move along, we can see roughly the fee structure. Again, with none of them being around for a year, we don't know what their total MER costs. These are leverage costs, custodial costs, marketing costs, the costs of paying the actual fund managers themselves. This is all the costs to operate the fund, where this is strictly paying the fund manager what it costs to manage the actual fund itself. And they all kind of are within a fairly similar band. They also trade, or their portfolio coverage is also fairly similar at 100, either 100%. Global X has decided to go in a fairly different direction, right? So more exposure for these funds to outperform. So that might be why that SPay, for whatever reason, a year to date, has been actually doing better than maybe some of these other funds. It's just that it has less portfolio coverage on it. And then as we go over to monthly distributions, monthly changes, they're basically all just, there's not much change. The biggest change is by Evolve Bond, lifetime change 5.5%, whereas everything else is 0%. And that's okay. I like seeing steady. These funds haven't been, like, their bonds are not really meant to be, you might think of them as like equity drivers, right? You're used to, stocks, say within the S&P 500 or the Canadian Stock Exchange, that their dividends grow on the regular, but bond covered call ETFs probably less so than the equity counterpart that undergo covered call coverage. Yeah, there's been a couple of little clips here with SPay and LPay, but is that something to worry about? No, I wouldn't say so. They've been, and we can see that lifetime change. They're basically just at 0% anyway. They started with 12.5 cents. They're back to 12.5 cents. So perhaps May was maybe a little bit of a one-off for each of these funds. Now what we can also do is just look at the liquidity of these funds as well. So we'll filter by, just because these are Canadian bonds, even though they're invested, no doubt, in American stuff. Let's just look at what their AUMs are looking like right now to give you a better idea. If you like the idea of investing in bonds and want exposure to it, you probably want to see how healthy these funds are doing overall. So what do we got here? We got basically all these funds. They're pretty healthy overall. We got green right across the board here. the fund by Evolve, like these are all very big funds now. HPYT, healthy with its current size. Even the Hamilton one at 100 million, really good. Bond by Evolve, like really good. These sort of smaller ones, Pace just came out, so the it's only been out for like less than a week and already at almost 2 million. The sort of smaller funds, maybe more kind of niche bond, LPay, MPay, SPay, right? They're growing, so, and they haven't been out that long, so they just need time to mature. Bond covered call ETFs are newer in Canada, and yeah, I mean, you can see that just how popular they are, especially with an older demographic, having exposure to bonds and having that sort of certainty with how bonds pay out their returns. Getting a little bit more yield with them, I'm sure, is a nice cherry on top of the cake. But nothing to worry about, it seems, with these funds. They're all growing, some of them newer than others. And I think the covered call bonds are going to have a place, no doubt, in portfolios to come over the long term. So yeah, lots to be excited about in that regard, especially if you're an older investor. I think seeing this kind of exposure and this kind of growth should give you maybe more confidence to invest in the bond sector if you haven't already. Hopefully you enjoyed that small snippet from the Covered Call ETF All-Star Tracker. Over on my Patreon, there is a 2.5-hour video that's going to be full of all of June's content. So, and as a last reminder, if you like the tracker, you want to see it for yourself, head over to the description below. There'll be a link and the very first comment that you see where you can head over to my Patreon, pick up the spreadsheet for yourself. So with that all being said, hit all the buttons of like and subscribe variety, and I'll see you all in the next video.